Ladies and gentlemen, good afternoon and welcome to the 2022 Brighter Super Annual Members Meeting. I'm Trevor Jackson and I'm your MC for today's proceedings. Before I begin, I'd like to acknowledge the traditional owners of the land on which we meet today and pay my respects to elders past and present. I'd also like to acknowledge any Aboriginal or Torres Strait Islander people who may be joining us here today. Okay, so just an outline for our agenda today. If I can get that slide to work, that'd be really good. There we are, that's the one. Firstly, we'll have a message from the Chair, John Smith. You'll then hear from the CEO, Kate Farrer, and then from the CIO, Mark Ryder. And then following that, we'll have our question and answer session. Following that Q&A session, if you're interested, we'll have staff on hand to offer super health checks, as well as members of our advice team and executive leadership team to help you with any questions that you may have. Would you like to answer that? A good idea to put your phone on silent if you can. Oh, not yours? Everyone's suddenly saying it's not me. That's okay. If you do have your phone on, please put it on silent. That would be most helpful. We're delighted to have representatives from TAL here today, and additionally we have a stand for Mates in Energy, but unfortunately they couldn't be with us in person today. In terms of housekeeping, for the question and answer session at the end of the presentation, just a couple of points to keep in mind. For those of you in the room who have a question, we'll ask you to please raise your hand, and then we'll have a couple of staff working either side of the room with radio mics, and they will run one of those mics to you. We'll then direct your question to the correct speaker to respond and give you the answer. In the interest of time, we'll have to limit taking pre-submitted questions and just questions from the floor today. As I said, we've got nearly 500 people logged in online for our session today. The other thing to keep in mind is that for those of you joining us via the webinar online, hello, thank you, welcome. Please feel free to submit questions via the Redback Live webinar feed, and it's very simple. All you have to do is click on the blue hand icon, and one of our team will personally respond to your question in the coming days. Okay, so before I hand over to our presenters, it's important to understand that the information and examples contained in the presentation are general in nature and have been prepared without considering your individual objectives, financial situation, or needs. It's important when making decisions about your super options that you obtain the relevant product disclosure statement and consider your own personal circumstances. Should you need help with your personal circumstances, as I mentioned earlier, we have a team of financial advisors who are able to work with you to make recommendations on how to manage your superannuation, investments, and insurance. So, ladies and gentlemen, without further ado, I'd like to hand over to the first speaker for today's annual members meeting. It's the chair of the Brighter Super Board. Please make welcome Mr. John Smith.
Thanks, Trevor. Good afternoon, members and guests. My name is John Smith, as Trevor said. I'm chair of the Brighter Super Group. On behalf of the Board of Directors, I'd like to welcome you to the 2022 Annual Members Meeting. Over the last 12 months, the Board's been focused on growing our fund and scaling it to the optimum size it needs to be, and delivering on the benefits of the merger between Energy Super and LGIA Super, and increasing our personalised service to you, our members, which is a unique feature of our fund that stands us apart from other funds. We've undertaken significant transformation work to transform the fund to one that delivers the best possible retirement outcomes for you, our members, into the future. To do this, we've combined the strengths of the three foundation funds that we'll talk about today to create a boutique offering that I believe is an ideal size to be sustainable in this market. I've been chair and former chair of LGIA Super since 2016. And over that time, there's been many milestones for our founding funds. LGIA Super was established in 1965. The fund merged with City Super in 2011, and that was the fund for Brisbane City Council employees at the time. And I was fortunate to be part of the history of the fund, being actuary to the fund in the 90s and also in the mid-2000s. Energy Super also has a long history. It was established in 1976, and the fund changed its name to ESI Super, or Easy Super as it was at the time, in 1995, and then merged with Spec Super to form Energy Super in 2011. And again, I was fortunate to have some of that history with the fund, having been actuary to the fund for 6 years during the 90s. You'll see the 90s as a theme here. On the 1st July 2021, we completed the merger between LGIA Super and Energy Super to create a stronger fund managing around $22 billion in assets. Together, we represent the best heritage and proud history of servicing our members in local government and energy and the electrical industry. However, even at $22 billion, APRA have made it quite clear that superannuation funds should be managing at least $30 billion in assets in order to be sustainable and to meet the needs of their members. So for this reason, and following an extensive due diligence process, we identified Suncorp Portfolio Services, now known as SPSL, as a suitable acquisition opportunity for us. And I'm pleased to say, after a lot of hard work, SPSL, that purchase was completed on the 1st of April this year. It's the first time that a not-for-profit industry fund has acquired a retail fund. The cost of the acquisition was $26.6 million, plus regulatory reserves. It was funded from LGIA Super's reserves with an excellent expected return and delivering benefits to members of all three foundation funds. SPSL currently operates as a separate entity, but our integration journey will complete next year, around May 2023, when that fund will successor fund transferred, become one single fund and one single trustee. On the 1st July this year, we launched our brand name, Brighter Super, and since that time, that brand has been rolling across our membership. So, as at the 30th of June 2022, the Brighter Super Group has more than 259,000 members and 29, pretty close to the 30, $29 billion in funds under management as a result of the SPSL acquisition. The acquisition of the business and the merger has given us the combined size and scale to deliver efficiently for our members, while maintaining that personalised and boutique service that sets us apart for the growing superannuation mega funds that are appearing. In the past year, the superannuation industry, just like every other year, has undergone constant change. Fund mergers have been increasing, particularly in response to APRA's requirements, as I explained previously. And also new regulations have been introduced, just that they are every other year. The government's Your Future, Your Super reforms came into effect on the 1st July 2021, and they're designed to improve transparency, accountability of superannuation funds, and deliver better outcomes for members. For both 2021 and 2022, our My Super product performed well in APRA's benchmarking test, and that must be assuring for members who are invested in our default My Super option. On the 1st of November 2021, the government introduced new stapling legislation. That requires employers to make super contributions to existing funds for members, unless the member directs otherwise. The employer can still choose the employer's default fund or another eligible fund. And I'm really pleased the way that's been implemented across our group, and the communications that we've been able to make to members. Good governance is essential in operating a responsible and sustainable fund for our members. As a not-for-profit industry fund, we put the members at the forefront of absolutely everything we do. Our corporate governance framework ensures that the roles and responsibility of the trustee board and the executive leadership team are clear. They're transparent, accountable, and must align with our corporate values. The trustee is governed by a board of directors. Our board has equal representation from directors appointed by employers and members, as well as independent directors. The board is responsible for reviewing the strategic direction of the fund and monitoring the implementation of that strategy by the executive leadership team, and to make sure it's in accordance with our governance framework. Following the merger between Energy Super and LGI Super, a new transitional board structure was established. It was made up of 6 directors who were member representative directors, 6 directors who were employer representative directors, and 3 independent directors. From the 1st of January 2023, the board will reduce to 9 directors, of which 4 will be employer directors and 4 member representative directors and 1 independent director. Member representative directors are nominated by our members, the Services Union and the Electrical Trades Union. Our employer representatives are nominated by Local Government Association of Queensland, Energy Queensland and other public bodies, and Master Electricians Australia. On behalf of the Board of Directors, I would like to thank our Group CEO, Kate Farrer, the full management team, and all the staff across the Brighter Super Group. Our staff have worked tirelessly this year in achieving the transformation that I've discussed with you. We often talk about doing our very best for our members. In fact, they deserve our best. What I'd like to say is our staff have done a fantastic job this year for you, our members, and thank you. I'll pass over to our Group CEO, Kate Farrer.
Thank you so much, John, and good afternoon, members and guests. And it's fantastic that you could take time out of your day to hear about what has been happening with your investment fund, but also investment markets over the last 12 months or so. It has certainly been a year of ups and downs for the superannuation industry, for markets and for the global economy. It's also, as you've heard from John, been a real year of transformation and growth for our fund. Looking back on the year, Brighter Super had some really significant achievements which I think are worth highlighting today. As John mentioned, the merger between LGR Super and Energy Super and the acquisition of SPSL has enabled us to increase our size and scale, and we're very proud to be a medium-sized boutique super fund. We remain committed to investing in personalised member services, and since our merger a year ago, we've met and spoken with over 19,000 members through in-person meetings, mostly in the workplace. But we have also had over 4,000 super health check appointments and almost 6,000 members attend our popular seminars and webinars. In the last financial year, Brighter Super's returns performed admirably in the volatile investment environment compared with our peers. So that environment did result in some negative returns over the short term and over last year, but I am pleased to report that Brighter Super's MySuper default investment option over 10 years has delivered an average of almost 7.4% per annum. Our Chief Investment Officer, Mark Ryder, is going to be discussing that and the reasons behind the performance in a little bit more detail later on. In our member satisfaction survey, we achieved a positive 20 net promoter score, and over the past year, our fund was rated better and more relevant to our members. So that means that we have more happy members who are willing to recommend us to others. I'm also very proud of our Super Ratings and Chant West Awards, where we achieved a platinum performance for 14 years running, and a 5 apples rating. It has been an exciting time since July of last year, and as you heard from John, our team's been working incredibly hard to deliver to you the benefits of the Energy Super and LGR Super merger. We've already been able to deliver some of those benefits to you, and I'm just going to outline some of those now because I think it's a real achievement on behalf of the team. On the 1st of July of last year, all Energy Super pension members received a reduction in their administration fee, which went down from 0.22% per annum to 0.18% per annum. I'm aware that that was communicated with you prior to the merger, but it was funded through the merger synergies, and it brings all of our pension members together under the same fee structure. In November of last year, we removed our weekly administration fee of $1 per week, $52 a year, per account. This means that members are being charged only the annual percentage-based administration fee, which you were already paying. That fee is 0.18% of your account balance per year and is capped at $900, which is down for former LGR Super members from $1,575. I'm very proud to say that we are now one of the very few super funds that do not charge both a weekly or monthly flat rate fee as well as a percentage-based administration fee. From the 1st of February of this year, members also received a tax refund of 15% on the annual administration fee. As this fee is deducted from members' investment returns, the tax refund is also applied back to the investment return, so you don't see it as a separate transaction on your statement. However, after applying the tax refund, the net result for every member is a net administration fee of 0.15% per year, which is really competitive. Through our increased scale and the diligent work of our investment team, we have been able to secure reductions in our total investment costs. Pleasingly, for our default investment option, MySuper, which many of our members are invested in, these changes resulted in a significant reduction in overall administration and investment fees and costs of up to 28% for LGR Super members and 29% for Energy Super members, based on a member's account balance of $50,000 for the 12 months post-merger. Some other options that had also seen decreases in overall costs were associated with investing, where the fee reduction also resulted from cost changes that we made to the strategic asset allocation, including savings made in the management of Australian and international shares and the private equity asset class over the 21-22 financial year. Importantly, ultimately, most members of the merged fund are now paying less fees and costs than they were in the predecessor funds, which demonstrates the benefit of the merger. As a merged fund, we will work very hard into the future to ensure that our investment returns support you and help you to build your best possible retirement outcome, but also that they are delivered to you at a price point that is acceptable and also reasonable. Whilst it's great to see fees and costs coming down, it is also important to consider how that compares with other mega funds in the industry. Recent changes in superannuation legislation require funds to increase their disclosure around fees and costs, and we have taken this opportunity to review how we compare with others. I'm very pleased to say that, as you can see from the slide, our offering to you, our members, does compare favourably in the superannuation market. It is important, however, to remember that fees and costs are not the only yardstick or benefit that you receive from Brighter Super or your fund. Considerations before making any change should also include investment returns, which you'll hear have been good, and other benefits you may receive from your fund, like insurance. Our fund offers competitive insurance, which is often designed for the industry in which you're working, and in some instances, the cost may be paid by your employer. Therefore, if you are thinking of changing, we strongly suggest you talk to our team to understand all your fund benefits as well as your fees and costs. This past year, the fund has delivered various digital and communications initiatives to improve your experience, which are part of our commitment to providing a really high level of service to you, and it is part of what we really want to continue to provide into the future. So you can see some of these up on the screen. We've expanded the range of seminars offered with more online webinars so that they're accessible wherever you are. We launched member-centric journeys to educate and guide you on your retirement journey. We delivered over last year over 75,000 emails to members at points that were relevant in their lives. We launched a new mobile app in February of this year, giving members an easy, convenient and secure way to manage your super. With our employers, more Queensland Council employees have started using our online information and education service Super Hub during the year. Plans are in place to roll Super Hub out to our energy employers and our employees over the next year, and I am pleased to say that the first of these has now gone live. I'm also pleased to say that Brighter Super is one of a handful of super funds in Australia that allows members with a KiwiSaver account in New Zealand to transfer these funds into their Brighter Super account. And finally, all members who are approaching retirement will have access to the Retirement Reward, which is a tax benefit that we pass on to members as a monetary reward when they open a Brighter Super pension account. Our branding change has now been delivered to both Energy Super and LGR Super members who are now members of Brighter Super. Importantly, we are committed to lowering our group's costs. Combining the three brands into one is reducing our costs and improving efficiency. As a not-for-profit group, these cost savings will benefit all of our members. So as members, you will have noticed some changes. Our website is now brightersuper.com.au and our fund communications come from Brighter Super. Our member online portal also now has this branding. We do acknowledge that for some members, particularly Energy Super defined benefit members, there is still some functionality to be delivered to you, like details on your benefit calculations, which were previously seen on the benefit quote. We're working hard to have this available to you, hopefully this calendar year, but we did not want to hold back on the existing functionality, which you currently have in Member Online, until these additional items were ready. We do greatly appreciate your patience and can assure you that there have been no changes to your defined benefit account as part of the merger or as part of the transition of our administration system. If you require more detailed information about your particular circumstance, please reach out to the team here today. There are many of them here. Brighter Super is a boutique superannuation fund that remains steadfastly committed to our heritage. We've spent decades managing the superannuation savings of our energy and local government members, and this commitment remains at the core of our fund. Ensuring that we continue to demonstrate our commitment to you as members is at the heart of our future, and you'll continue to see us in your workplaces and in regional centres right throughout Queensland into the future. So, having undertaken our recent merger, I did want to clarify a few key points that remain central to Brighter Super now and into the future. First of all, Brighter Super continues the proud heritage of our predecessor funds and remains as a not-for-profit industry fund. This fund structure is important to you as members and to us and will continue into the future. Secondly, we remain committed to our core industries, energy and the electrical industry, and local government. We have very core partnerships with them on the energy side with Master Electricians Australia, the Services Union, Mates in Energy, Electra Group and the National Electrical Contractors Association Queensland. On the local government side, we have partnerships with the Services Union, LGAQ and LGMA, amongst others. Partnering with these organisations allows us to invest in the future of these industries and demonstrate our commitment. We come to you where you work. We have more than 40 team members, which I think is more than any other super fund, dedicated to working directly with energy and local government industry employers and employees across Queensland. And finally, unlike some other industry super funds, we offer default income protection to most members. This means when you can't work because of your injury or illness, you may be eligible to receive income to support you and your family. So it's been a really good year, and as John said, wouldn't have happened without the team. So finally, I would like to acknowledge my executive leadership team and the broader Brighter Super team. The executive leadership team and staff work closely with our board and have worked really hard, as you can see, to deliver the best possible retirement outcomes for all of our members into the future. Over the past 12 months, we have welcomed some new executives, including our Chief Investment Officer, Mark Ryder, who you're going to hear from next, our Chief Technology Officer, Randiki Gajanaiki, and our Chief Transformation Officer, James Guyton. We did farewell Troy Rick, Ivan Ortiz and Andrea Peters, all of whom played important roles in our merger journey. So thank you to them, and thank you all for your support and for your time today. I'll now hand over to Mark, who's going to give you an update on the fund's investment performance. Thank you.
Thank you, Kate, and good afternoon, everyone. It's a pleasure to be here to talk to you today about your fund. First of all, what I want to do is, First of all, I want to do is talk about our approach to investment. How do we build the funds which you invested in? I'll talk about performance, and after that, I'll talk about the recent economic trends and market events which are driving the returns in your fund. First of all, on terms of that, our objective is to deliver strong, long-term performance for your investments. We do that in a diversified and risk-controlled way. And diversified, we invest in a mix of assets, and I've got some of them listed up there. You can see in terms of we list in shares, property infrastructure, listed and unlisted, in private equity and debt, in terms of bonds, cash, a whole range of investments which provide a portfolio which will provide the required return, but actually do it in a risk-controlled way. What our objective is not to put all of your eggs in one basket. We also want to deliver this with lower fees, and we want to do it in a way where we're in a responsible and a sustainable approach to investment, to generate returns, and what's good also for society. So how have we done? This slide here shows you the returns on the left-hand side for the key accumulation product, the My Super Fund, and on the right we've got the pension fund. In the left-hand one shows you the last 12 months, and as I think Kate referred to, it has been a difficult year, and I'll talk a little bit more about the factors which drove that later, but you can see that there have been some negative returns there in My Super and in pension. But superannuation is a long-term game, and it's those long-term returns which are critical. If we look at the accumulation fund, the My Super Fund, it's returned 7.4% over 10 years, and the pension fund has returned somewhat more. What that actually means, if you look at it over a 10-year period, is that your fund, if you invested $10,000 10 years ago, it's doubled over that period. As the chart also shows, investing is not without risks from time when markets go up and down. We're in a current down phase at the moment, but the long-run trend is up, and our objective is to deliver returns for you well in advance of the CPI. A bit more on diversification. When we talk about diversification, we do it in a number of different ways. We can do it by asset class, as I mentioned, different type of bond or share or the like, infrastructure or property, but we can also do it across the world, and we can diversify across regions. And what this chart here shows is actually just the range of investments that we've got throughout the world. If we're going to different parts of the world, it means that we're going to have different factors which are going to be driving the investments, and that helps build that diversified portfolio. Where have we got those investments? We've got investments across the world in agriculture. We have investments around the world in real estate. We have investments around the world and in Australia in energy, as well as investments in critical ports, such as in Newcastle and in Portland. So building that diversified portfolio comes about by spreading those investments around, and that includes the world. But it also means at home and here in Queensland that we've got a diverse range of investments as well, spread out throughout the state. Critical ones, and very much you live with them and around you, and helping the economy as well as helping you the way that you live. We're actually owners of a range of airports, or part owners. Sunshine Coast Airport, Gold Coast Airport, Cairns, Townsville, Mackay. So critical for you to enjoy your holidays as well as for the tourist industry. Infrastructure, the Gold Coast Light Rail, we're a part owner of that. North Queensland Gas Pipeline up in Gladstone. Various property, entertainment, we own the land which Movie World is on, and childcare facilities, and it goes on. There's a range of investments, all different drivers, but to bring about a diversified, but providing a return which is what you require in your investments. But what we also do is invest in a sustainable way. What does that mean? What it means is trying to build a portfolio in a responsible way where the 4 principles we use, it must be in your best financial interest. It's your money and we've got to do what is in your best interest. That also means that not taking, only taking any impact at all on your return. It's got to be negligible in terms of impact on the risk or the return. And that's a key part to delivering that best financial interest. It must be genuine in its intent and the outcome. That what we're attempting to do is actually to help drive the transition which we're looking to drive say if we look at the example in terms of energy. And we're also doing it in a way where we don't believe on just simply excluding investments. We work with managers who build the portfolios and the decisions they make whether it's a good investment or not. What we're looking to do is actually to engage and use stewardship of these assets to help drive change in industry when needed. To give you an example of some of the sort of energy type of transition assets we have, I've got 2 examples here and give you an idea of the impact that they have, as well as actually the type of impact they also have on local communities. First one on the left is Cooper's Gap Wind Farm in Queensland. There are 123 wind turbines in this one. It actually helps power 232,000 houses. It created 200 jobs in construction and 15 ongoing. Or if we look at Rye Park Wind Farm in New South Wales, which is currently under construction, similar sort of stats, 65 wind turbines. It's powering 215,000 homes and creating similar amount of jobs as well. So these are investments which are good for returns for your portfolio, as well as actually good for society. There are other investments we've got as well, and they say a picture's worth 1,000 words, and so let's have a look what some of these actually look like. For example, this one here is Hexia Renewables. It's a developer, a constructor and operator of renewable energy projects in Taiwan. And you can see there the various large fields that they've got of solar panels. In Australia, closer to home, in Victoria, we have wind farms here. We've got a part owner, 80 turbines. It's 23 kilometres north of Mortlake in Victoria. Once again, a good investment for the fund, but actually good for the environment. We also play part in the society and in the where we live, and that here's Robina Town Centre. So a shopping centre. It's part of a fund which we invest in, which QIC run, and it's the second largest on the Gold Coast. It's also got a bit of sustainable angle as well. This one, it has the largest rooftop panels installed in the Southern Hemisphere, all 9,000 of them. So you can keep that in mind if you're going through it, just that it's actually doing that in a sustainable way. And also good for the environment, ecosystem. It's got 36 beehives there as well. And I mentioned earlier about that one of the major assets that we have is actually Sunshine Coast Airport, where we're actually 50% owner, or you're a 50% owner of that. That in terms of that, it's really a key asset for the portfolio. It's a key asset for the region, and it's one which we're very confident of in terms of the growth outlook and returns from it. So that's what we've built for you and some of the examples of the investments we've got. But what's been driving returns in the past 12 months? This chart here shows you on the left-hand panel the trend in the stock market in Australia and the United States. It's indexed at 100 just before zero, just before COVID hit. In terms of the middle panel, it shows interest rates for government bonds in Australia and the United States. And the final panel is the Aussie dollar. And as I mentioned at the start as well, that returns have been modestly negative through the last financial year. And it was very much a year of two halves. The first half saw markets moving upwards. But as we rolled into the beginning of 2022, equity markets started to turn, and particularly in the United States, where we had, from peak to trough, and we're up a little bit off that trough at the moment, a 30% decline in the US share market. Australian market has performed somewhat better, only posting a more negative, a slightly less negative return last year, and that reflected the benefit from being an energy producer. And what was driving that, and I'll detail a little bit more in a minute, is to do with what's been happening with interest rates. You can see government bond yields have spiked from 1.5% just a bit over a year ago, now actually around 4%. And the Reserve Bank and other central banks around the world are aggressively raising rates at the moment. There's still more to go. The Aussie dollar has actually dropped from close to 80 cents down to a recent low of 63 cents. And it's dropped as the US Federal Reserve, the US central bank, has outpaced the RBA and its move on rates. This chart shows you the returns for some of the listed asset classes over sort of shorter term periods. And what it actually shows, if you go looking from the left to the right, Australian share market through last financial year posted a negative return of 7%. The world share market posted a return of around minus 15%. We also saw weakness coming through in property. This is listed property, while infrastructure did somewhat better and posted a modest positive return. But probably one of the characteristic differences of this downturn has been that bonds, fixed income, has posted negative returns around 10% as well. This is normally in portfolio as a defensive buffer of the portfolio, but it actually declined along with share markets, and for the reasons we'll talk about in a minute. And cash is finally back, providing some modest positive returns. Your portfolio is also built with not just listed assets, but because we're looking for diversification, listing in a range of other assets, in private equity, in unlisted infrastructure projects, in property projects, as well as a range of alternative investments, which are in areas such as in insurance and in agriculture. And all of the combination of those assets, along with the returns that we've received, you can get an illustration of some of them here, was the drive of the returns which you saw in your portfolio. So, what's actually been driving this changing trend? It really comes down to one thing, and that's inflation. One of the big mega trends of the last 30-odd years, not just in Australia but around the world, has been low inflation. This chart shows US inflation and Australian inflation back to the late 1940s. They move fairly closely together. You'll notice that there was a big spike in inflation, which probably a lot of you would remember, back in the 1970s. Following that spike, inflation moved down, and for the last 30 years, it's been very stable. And as you can see right at the very end, the last 12 months or so, we've got inflation jumping up to around 7 to 8%. That was the first mega trend, that we had low, stable inflation after a period of high inflation. What that actually drove, if you look at the second mega trend, which is to do with valuation in asset markets, and specifically in this share markets. The red line, and this goes back to, I like long-run charts, this goes back to the late 1800s. The red line is actually the US 10-year bond yield. It's a long-term trend. The blue line is actually the price-earnings ratio of the US share market. So think of the average price of the share versus the earnings at the average earnings. And that's a basic share market valuation measure. As you can see, that inflation spike in the 1970s drove bonds up from low single digits up to a peak in the United States of 16%. We had a similar trend here in Australia. You may remember that we had short-term interest rates, the RBA set at 18% at the time. You can see that as interest rates started moving up in the United States, the share market went down. Markets don't like inflation, in terms of share markets, raises risks, and also as you increase interest rates, it actually provides a challenge to the returns on equity markets. So we saw the markets derate, which is the PE actually fell. Look from now up from 1981 through to really just a couple of years ago, and you can see that there was a one-way for interest rates. It was down and down and down and down. What that meant as interest rates fell, and what we saw was that share market and valuations rose. So they rose from probably averaging 70 for the previous 100 years to actually moving up to something around double that. And so share market loved low inflation, interest rates fell, and that's the point where we were before COVID hit. So the pre-COVID world we actually had was one where we had declining real interest rates were falling faster than inflation. We had low inflation around the world. Assets were rich in value, and one of the other characteristics which became critical in the post-COVID world was China. The rise of China saw sort of particularly complicated supply chains and intricate supply chains being built around the world. And then finally, the one is that there was probably pre-COVID, there was a rising concern about inequality as wages growth were lagging behind profits. So that's where we were pre-COVID. So what happened at COVID? The response from governments on a number of fronts changed. COVID, the lockdown was actually caused by government, so they felt compelled to actually provide support, which they did, and budget deficits blew out. Central banks saw that inflation was actually low and maybe falling a bit, and at that point, they actually decided to cut rates even further. A number of countries around the world had negative interest rates, and then probably the final part came down to when government support actually led to a build-up in savings, and then some of that savings were actually then used to buy goods. We're all locked away. We could spend on things we could use around our home, but we weren't travelling, we weren't going to restaurants. So spending spilled over to demanding goods. So generally there was once COVID started to ease, there was a very strong stimulus in the economy, big government spending, low interest rates, and of course we also saw that the government was effectively, or through the Reserve Bank, printing money as well. Strong demand was a feature as we bounced out of COVID. But that was one side. Economics is about supply and about demand and supply, and the supply side basically was impacted quite significantly by COVID. Supply shutdowns occurred across a range of industries, and what we started to see, as shown by this next chart, was that with a combination of surging demand and issues to do with slower production, issues in shipping, that a good example of a supply issue or a supply chain problem is shown here, where the price of shifting a 40-foot container around the world with goods actually went up fivefold from mid-2020 to mid-2021. And that was one of the key drivers which was pushing up the costs of goods. Now, as you can see, that's beginning to wane, which is good news, but that's only part of the story, because that waning is coming partially on the supply, improving, it's coming on demand starting to weaken, but the thing which central banks are worried about now and why they're still raising interest rates is to do with the second round impact, and that's to do with labour markets and worker shortage. Chart on the left shows US unemployment, and it shows that US unemployment's at its lowest point in close to 60 years, and wages are accelerating in the United States. In Australia, we're lagging a bit behind. Unemployment is low, not quite as low as in the US, but what we're actually finding is that the job vacancy, that in Australia at the moment, there's one job vacancy for every unemployed person. Go back to 1995, there were 10 unemployed people per vacancy. Sounds like a worker shortage to me, and not surprisingly, wages are picking up. So that's why central banks are raising despite some of this being very much driven by COVID supply side, but they're removing the stimulus on demand. So where do we go from here? As I mentioned, we've had a combination of supply and demand shocks. Central banks completely misread the situation and now playing catch up and raising rates. Inflation is probably, I think, starting to peak, but the big questions now really will be, are we there? And how much will it come down? Because that will dictate how much central banks can ease up on interest rates. In terms of recession or soft landing, if it's a recession, it's much harder on company profits, and that'll clearly have an impact on the companies and the businesses that we invest in. Markets have picked up recently on hope that central banks start to pull back a bit on their rate hikes, but they're still saying that they're going to be raising rates. And I think at this stage, I think when I look out for the next 12 months, that while we're well into this adjustment, we've seen share markets move from being expensive, but they're probably back to being around fair value. There are still risks out there. There are a number of different scenarios you can paint, but I think we're still going to find over the next 12 months that it will still be a challenging time for markets. Markets will always attempt to front run and move in advance of events, but I think for a while into next year, we're going to continue to find that returns will still be problematic. With that, I'm going to bring my presentation to an end and pass it back to Trevor.
Thank you, Mark. Thank you, Kate, and thank you, John. Now, ladies and gentlemen, it's your turn. Our Q&A session, and we'll open to the floor. And just a reminder that you have John, Kate, and Mark available to answer your questions here this afternoon. We've received a large number of questions prior to today's session, and we greatly appreciate the interest from all of our members here. We may not get to all your questions today, and we do apologise for that if we can't do so, but we will respond to your question in the near future. Also, if your question relates more specifically to your own circumstances or how your super account works, for instance, then we suggest talking to one of our team here today who can provide you with a more detailed response. Time is limited today, and I apologise if we can't get to cover everyone's questions in the time allowed. We will do our best. We will aim to answer one question per member. However, if we can't respond to your question within approximately 2 to 3 minutes, then we will follow up with you personally following the meeting today. So to start things off, we might ask a pre-submitted question first, and this one is for Mark, who's only barely had time to catch his breath since he sat down. This question is, do you expect the market to pick up by the end of the financial year?
How is my crystal ball looking? Look, as I suppose, closed with, I think, looking into next year, I still think there's a bit to play out in the current market cycle. We've got the slowing in the global economy hasn't really played out at this stage. Interest rates have gone higher. It takes time for that to impact. Markets do attempt to try and look forward and move in advance, and they're trying to do that at the moment. But I still think that looking into next year, that it's still going to be probably a challenging time on returns for a while yet.
Is that largely because there's still so much uncertainty in the market?
Well, I think when you look at it, there's a range of possibilities. Does inflation peak and drop quickly? If it does that, then central banks can suddenly reverse what they've done, and that's probably going to support growth and markets. But if inflation proves more problematic, if rates continue to move higher, and they've moved in record pace, and in this environment with much higher indebtedness, we're not quite sure exactly how much and how quickly they're going to bite. So I think there is a range of uncertainty there where given that inflation is the problem this time around, before it wasn't a problem and central banks thought they could ease up very quickly, this time round I think they're in a situation where they've got to do it more cautiously, and I think that adds sort of a degree of uncertainty to it.
Thanks, Mark. We'll take a question from the floor in a moment. Just one more of our pre-submitted questions. This one's for Kate. Kate, how is the fund protected from cyber attacks? We've seen a lot of cyber attacks on some very high-profile, very large organisations lately.
Yes, thanks for that question. It's one we get asked quite a lot, actually, because we know we've got some very important data for you. So, look, safeguarding member data is incredibly important to us, and we have spent a significant amount of time and effort over the last couple of years making sure that our protections are fit for purpose. And those protections include protections in getting into our system, which we test all the time. We make sure it's very secure and we do test it. But also operations, our team. We spend a lot of time training our team to be on the lookout for fraudsters or for cyber attacks or some sort of scammers. We have seen a definite uplift in scamming in the industry, and in fact, most of the observations that we'd have for superannuation would be around fraud. So we have uplifted our fraud protection controls as well. And I guess what I would ask members is just make sure that you are very careful of your own identity information and the information about your own superannuation accounts, because that has been an area where we have seen some members subject to attacks in the more recent past.
Thank you, Kate. We've got Stacey over here with the microphone. I think Youssef on this side of the room. There's a gentleman here very eager with his hand up. So, Youssef, we can get a microphone up to the third row here. It'd be great.
Can you hear me?
Yeah, a little bit closer to your mouth. That'd be great.
Okay.
Thank you.
Very difficult. Thank you for giving me the privilege to ask a question. I've asked this question a couple of times and it doesn't seem to be answered. Now, concerning cash enhanced and high interest options within the portfolio, how come they are so poorly performing, and what do you see is going to change that with interest rates going up? For instance, I can get 3% at call at the moment in a 24-hour account. Now, through Brighter Super, it's best 0.7%, and it's been lagging to negative. So what will change that? Thank you.
Mark?
Thanks for the question, because I think when you do look at the current episode, we do find that the returns on the more defensive options are not that different to what we've got on the growthy ones, which is sort of unusual. The reason is because the way that the more conservative portfolios are made up of predominantly they've got a good degree of cash in there, which is important, but then they're made up of bonds. The way bonds are valued is that when a bond is issued, it's issued with a certain amount of interest it's going to pay. When market interest rates rise and that bond gets revalued, the initial impact is for the price of the bond to decline. So what happens? The price drops. Now, if you invest in cash or something, if you invest in cash, basically interest rates go up, basically you'll get paid higher interest rate. The higher returns in a bond portfolio will only come after we've seen that the increase in interest rate coming through. But the initial impact on a bond portfolio, the way that it's priced, is that interest rates move up on a bond and it's paying a fixed amount of interest on it. The price of the bond actually drops. And so that's the reason why that the portfolios perform poorly. Going ahead from here, with interest rates moving up, returns will improve.
So bonds are a much better longer-term investment?
Well, at the moment, the solution to getting higher returns in more conservative portfolios is to get interest rates higher. But unfortunately, when you're going from a low level, there is this capital loss that the bonds actually make in the short term.
Okay. Another question from the floor? Yeah, this lady in the middle here. Stacey, can you see? Where are you, Stacey? Oh, there you are. Yeah, just in the middle here, right on the aisle. The lady in the mask here. You had a question in the green top? Yeah? No? You want to raise your hand again, just here? You had a question here? No? Yeah? Oh, there. Thanks, Youssef. Thank you.
Yeah.
Oh, sorry, there's a gentleman there. I'm sorry, I couldn't see.
That's all right. I'm
light
short.
in my eyes, so I beg your pardon.
I'm a bit small. That's why I'm probably. Yeah. You were talking about shares across different parts of the world. I mean, I'm just thinking that in the past, China tended to be, the economy was going really well until recent time, and now with the COVID shutdown, does that have any effect on how you choose what funds to go into, and do you need to be careful in terms of countries like China now?
In terms of the way that we invest, we will tend to choose a fund manager. In a lot of cases, we're not going to invest just in a single country fund. We invest in an Australian share portfolio, but in terms of a global portfolio, it tends to be a number of countries. And so it's a case of that the fund manager will then actually make that decision. What are the best companies within that country? So it's not a case of just simply saying, don't invest in China. Our approach is not to actually say, look, don't definitely go to a country, don't definitely exclude that company. We're choosing these fund managers who are on the ground and speaking to these companies to actually find those best investments. But there's no doubt that one of the issues now around investments in China is just the ongoing approach on COVID, and we've seen that there has been some protests across the country around that. And so what's happening in China is not just impacting the direct investments there, but what goes on in China, given how important it is, will also impact elsewhere, because it's been a factory of the world. And one of the things which drove some of that inflation higher around the world in the last couple of years has been supply shortages. And so ongoing issues in China will have impacts not just on the Chinese companies we may or may not invest in, but it also impacts the broader investments, just given how important it is in the world economy.
Another question, please. Just here. Yeah, thank you.
Panellists, my name's Tom. Thanks for the update at the start there. I had a look on the website. I've just discovered that our fund does have a financial planning business, which is really quite interesting, including the leadership team. I counted 18 planners as part of that business. Now that puts the wealth management arm of our fund in the 98th percentile of financial planning businesses in the country. So I was quite curious about the noticeable absence of corporate communications regarding Michelle Levy's quality of advice review, considering how significant our fund's wealth management business is and how much we're set to benefit from that.
Yeah, thanks very much for that question. So we are incredibly proud of our advice business, and we have the leader of our advice business in the room over here in the yellow. If you want to talk to her at the end, she'd be very happy to talk to you about the quality of advice review, actually. Look, we tend not to comment on activity until it becomes law. Quality of advice review is going through a consultation phase at present, but I think it's fair to say that we're excited about the opportunities. Our philosophy or our strategy is for advice-led conversations to drive every one of our interactions with members. And if we could meet with every member face-to-face and have an advice-led conversation with them, we would. So we do offer a range of different types of advice, from general advice all the way up to full comprehensive advice. And, you know, we always make sure to say to members that if there are any personal issues or circumstances that they would like to discuss, then the team is here. We've got 3 of our advisors, in fact, up the back. We've got an intra-fund advisor and 2 comprehensive advisors here, I think. Raise your arms, guys. Thank you very much. And Katerina. Look, I agree with you. To sum it up, advice is really important to us. We are investing in it a lot and will continue to do so. It's central to the strategy. We do think there's opportunities in quality of advice review, but I also have to say there's a lot of debate about whether or not it'll be implemented as it stands. So we look forward to finding out how it goes, and once it causes changes in the law, that means that we can change our offering, then we'll definitely communicate with you.
Thank you. Thanks, Kate. Yeah, there's another question here, Stacey. Thank you.
Yeah, thanks, mate. Listen, when you're heading for 100, your memory goes a bit, but you might be able to correct me on these. I was in the electricity industry for all my working life, and in about the 1980s, I think Terry McEnroth and Goss might have been in government. The Energy Super had 360 million in cash reserves. Yeah, they were transferred to the government in exchange for a government guarantee that if the fund didn't have enough money to cover its needs, the government would step in. Now, we're thinking, we wonder whether the market's going up or down. I think Warren Buffett said one time when he was asked what the market's going to do, he said, it'll fluctuate. And I think that's as true as anything anybody can say. What concerns me is the independence of the board. Now, coming out of the LGA in the electricity industry, there's political influence and union influence. Now, both of those have their own agenda, and quite often it's the members that get the short end of the stick. What steps are in place, can you tell us, that would satisfy us regarding the independence of the board?
John, you've had a lot of experience in the industry.
Being the former actuary to the fund, that event that you described in the 80s obviously was pre my understanding of it. So the first thing to say is we have a number of defined benefit funds. There are 2 defined benefit funds that look after local government employees, one City Super and the other one regional. And then there is the ESI, effectively heritage defined benefit fund. That defined benefit fund uses an actuary like I used to do. So we do have an independent actuary that will give us advice on the financial position of that fund. I can confirm for you, even with this correction in the market, that fund is very healthy, and therefore security of your benefits is very high. The contributions that were required for that fund, because the fund is shrinking in size, anything that's excess to requirements is getting larger as a proportion of the remaining members. So people are leaving because it's closed to new members. So the fund is starting to reduce in size, but the level of assets, the amount to which that's excess, is actually growing proportionately. So your security is actually going up as time goes by. So there is no provision to return money to the government. There is a provision to ask employers to pay more money, or if they don't need to pay more money, to return some of that money to them. And that's the only, we don't pay money back to governments, that's for sure. Or anyone else for that matter.
Another question? Stacey, there's a gentleman here in a blue shirt.
Stacey. Norm Craswell. I wanted to ask Kate and John, have you got any more acquisitions in the pipeline? I remember talking to you, Kate, last meeting, and you talked to me about 50 billion, being sort of the optimum amount. Do you have an optimum amount for the board? And the second question, part of that is, are we in the situation where a much bigger fund could come looking at us and say, well, we'd like those people? Bingo.
Yep, great question. Thank you very much. That's terrific, because that's exactly what what you need to think about in this environment. So shortly after the merger between Energy Super and LGIA Super, we did say, okay, we've met this target. We knew we were working on the Suncorp acquisition, and so we were hoping that we would get to that 30 billion, which is really the APRA threshold. What we're seeing in the market is there's the mega funds, which are the 200 billion plus funds, and then there is a cluster of funds that sit between 70 billion and above that are well short of those mega funds. So what we did was assess where do we need to be where we can maintain that boutique face-to-face member servicing that is different to the mega funds. That's completely different to what they do. So how can we maintain that and still keep reducing our costs and making it very efficient for you to be a member of the fund, and therefore increasing your retirement outcome? And so our assessment, with some help of some professional advisors, is we think there's a cap around 50 to 60 billion. So that number you've mentioned is exactly what we've reaffirmed. So at 30 billion, we have some room. So we think we're very sustainable where we are, but we could do one more. Now, with the consolidation in the market, there are fewer and fewer dance partners, if you like to call them that we can do that with. So I can confirm for you that we have ongoing discussions. They're not particularly detailed at this stage, but we are having ongoing discussions because we want to understand what's out there. Do they have the same aspirations as us? Because we could find another fund that's similar size to ours, but perhaps they don't value that boutique member servicing that we do. So back to your question about if a big fund came in, we're still responsible for you. So the board would still have to approve anything. We have no interest in a mega fund acquiring this fund. It would destroy what we've built through energy and local government. The servicing aspect is so important to us, we wouldn't give that away.
Thank you. Thanks, John. Might go to another of the pre-submitted questions. This one is for Mark. And the question is, what is our super fund doing to divest itself from fossil fuels and focus more on our investment in renewable and sustainable energy? And obviously, Mark, you gave some examples earlier today. But...
Yeah, thanks, Trevor. Look, I think what we've recently sort of introduced an ESG responsible investment policy for the fund, and look, part of that I've set out the things that we're looking to, those 4 points, and really it's about being part of the transition. It's actually, we're looking to potentially be part of the Queensland Government's jobs and energy plan, but we're not waiting just for that. We're actually investing, as I illustrated, around Australia, around the world, in different energy projects, which are part of that transition to get us from where we are now to a more sustainable future.
Okay, another question from the floor.
Thank you. I'm just following on from what the first gentleman asked about interest rate that he can get from his bank. I agree with that statement. So I've gone to my bank and they said they can give me 4% on my money at, which is far better than what my return is currently in Brighter Super, where the secure option offers me 1.58% year to date and stable offers me 2.82. So, I mean, I know it's not that simple, but so, for example, why can't Brighter Super offer an investment option that allows me to put my money in a term deposit where I'm likely to make more money than I can with City Super currently?
Look, I suppose in terms of cash investment, there is a cash option there. So there is an option to go into that. If you look at the more defensive options, such as defensive or and those with the sort of more defensive ilk, there's a combination of equities there along with sort of the fixed income cash type investments. And over the longer run, that additional exposure will actually provide additional return. But as I mentioned at the moment, the issue we've come into, and you can see that chart earlier, that we've been on this sort of 30-odd year journey of falling interest rates. As interest rates actually fell, that boosted return in bond portfolios. Now what we're starting to get is the reversal, and as we actually see interest rates move up, the initial impact is for the value of those bond investments. So this is different to cash. The issue is when it's sometimes referred to as fixed interest. It's fixed in terms of the coupon you might be paid, but it's not the percent of the return is not going to be stable because of the value of the investment. It's different to cash. Cash has got a stable value. A bond doesn't have a stable value, and so that's the difference. It's been a rapid adjustment, and those portfolios have not performed as you would hope.
Makes sense talking about over the short term, but people here, from what I can tell the demographics, they don't have 10 years to wait or 15 years to wait for all those bond things to come back up. I don't have that time. So that's why I'm in those defensive modes.
So can I just make a comment? So first of all, thank you so much for raising this, because this has been a topic that we've had questions from members on all around, frankly, Queensland, because it has been a really difficult year for those low-risk options. What I would say is that it would be potentially worthwhile if you're looking at your returns and saying this is just not good enough. It would be worthwhile you having a conversation with one of our planners. We do offer as a free service, or I shouldn't say that, but as part of the cost of your membership, an intra-fund advice offering around investment options, where you can have a conversation with a planner about your relative risk and return options and how that might position you in the current environment. So we definitely have a lot of empathy for all the members who are invested in low risk options at present. They have not performed, as Mark said, they have not performed as we would have hoped. Fixed interest markets have had really, really rapid adjustments. But that doesn't mean that over the long run they haven't performed reasonably well and robustly and as you had intended. So it's definitely worthwhile having a conversation. We have one of our intra-fund advisors up the back here. You can go and talk with her and just see whether maybe there's a different way of thinking about it.
Another question, please.
There's been a lot of talk about energy, which you've touched on, but also housing. Can you update members on if you've got any initiatives around social housing or aged care investments that you're considering?
Yeah, thanks very much for that. Look, we're still a small medium-sized superannuation fund. As you've heard from John, 30 billion was kind of the threshold, and that's where we are. And so the amount of available funds that we have for illiquid assets is constrained. It's not large. Given our membership base, our focus is definitely on the energy transition because that is where our members are impacted most. And that's the bit that Mark has been doing work on, how to make sure that we can deliver to your best financial interests whilst also supporting our members who are going through that sort of transition, once in a lifetime transition.
Is that more an ethical decision, Kate, and combined with obviously trying to represent the best financial outcomes for your members as well? You're walking a fine line, but there seems to be a lot of questions around sustainability, ethical investments, those sorts of things. I know someone else, there was another question about what plans have you got to reach a net zero target by 2050, like, kinds of things that governments won't even commit to. So, how do you weigh all that up in terms of the direction you take?
Yeah, no, it's a really great question. There's no question in my mind that members are expecting us to ensure that the way that we invest delivers good outcomes for society, but most importantly delivers in the best financial interests of our members. We think that because we have members who are connected with the energy industry and themselves will be part of a transition as we speak, that it makes sense for us to try and support those members through that transition. And so we have put quite a bit of effort and thinking into how it might be that we can extract yield for our members, but also support them as we move forward on that. So to me, it's a question of specialisation. Mark once said to me that the funds that do the best are ones who decide what they're good at and do that. And so I think that this is one of those areas where it makes sense.
Great. Another question, please. Oh, the back up here. Yusuf, might be closest, I think. Thank you.
Hello. In addition to the discussion we were having on the fixed-term cash rate, we've obviously seen inflation rise rapidly. Mark, do you see the cash rate falling in relation with inflation, or will it be likely to hold up for a longer period of time?
My expectation is, I think probably at the moment, I think the current high level of inflation is not expected to perpetuate. I think it will decline, and I think that gap we're seeing between interest rates and between inflation will actually close. The normal situation is for interest rates to probably to be, if anything, a bit above the inflation rate. So you've got a positive real interest rate. At the moment, though, you've got it's about -4% because inflation is 4% higher than where cash rates are. So inflation will come down. The question at the moment, I think, will be how quickly. But I think we're going to get into a situation where, whereas we've seen, I think in the last, really for a lot of the last sort of 5-6 years, we've had this very, very low interest rate structure. Inflation's been a bit higher. I think COVID's probably, and the response is getting us to a situation where we're going to find probably it's going to look a little bit more normal. Rates are going to be still lowish, but I think you're going to find that cash rates probably will end up being a bit above inflation over the medium term, so that there will be a bit of a positive real rate. That will actually then flow through to bond investments as well. I think this period of just negative interest rates, which we had in Europe, and very low sort of negative real rates here, I think what's playing out now is seeing that come to an end.
Okay, and there's another gentleman, I think you've already got the microphone, yeah, the striped shirt. Thank you.
Yeah, I was just listening to a couple of questions before where someone was asking about the interest rate they can pick up from the bank being higher than the interest rate. And you keep coming back about bonds. But I wonder if really what he's asking is, instead of taking his money out of Brighter Super, can he put it into a cash thing where he gets an equivalent to what the banks might be paying? Is that possible?
There is a cash option that we have available for members now. But once again, on that one, it's a case of really, in terms of changing strategy like that, it's an important one to get appropriate financial advice on that. But we do actually have options. We do have an option available which does provide cash and doesn't contain fixed income investments, which are in the more defensive portfolios.
Would your cash rate match what the bank was?
It depends upon what interest rates and term deposits can go up and down, but it actually does provide a margin above what, say, the RBA cash rate is.
And this is only recent, Mark, isn't it? I mean, not that long ago, interest rates were basically nothing. You were getting nothing from the banks if you're putting money in there. So that's only, since the official rate's gone up, we're starting to see now reasonable returns.
Well, that's right. You're starting to get more reasonable returns, and I suppose that of course a number of countries overseas actually had negative rates. So that was even negative nominal rates, even a worse position to be, and you had to pay the bank to put your money there. So. I suppose the point here is that there is a cash option which is available.
Thank you. Okay. Yeah, Yusuf, thank you. Yes.
Mark, in your diagram of the world, you showed quite a lot of overseas countries where you have investments, and also quite a lot in Queensland. Of the $29 billion that you have invested, is there a proportion that you look at overseas versus Australia, considering overseas is fairly volatile? Is there any sort of figure or target that you feel you're comfortable with for the members?
Yeah, that's a good question. Look, when you look at the moment, I suppose part of the thing is when you think about the exposure that you have to Australia compared to the world, as percent of the world share market, Australia is about 2%. So it's not very large. In the portfolios we have what we do call a home bias. That if you actually look at the diversified funds that we've got, something like the MySuper, they're carrying around, let's roughly say about a quarter of the fund will actually be in Australian equities. So it'll be BHP, Rio Tinto, etc. Now there might be Australian-based companies, but they are exposed to the world. Then you'll have about a similar amount, a little bit more in global shares, which will be spread around the world, probably 60% of it in the United States, and then the rest of it, another group of countries. Then when we do asset classes such as fixed income, we tend to have a bias towards Australia over global. And when we look at property, would be an asset class where we generally have about 10% in property. We generally have the bulk of the investments are in Australia. In infrastructure, it's a mixture. So what we're looking at is in equities there is a clear sort of target we've got. Elsewhere in the portfolio, it comes down to the opportunities which are there. But there's definitely a a bias towards having Australian assets. But one of the benefits, though, of having overseas assets in a portfolio is that if you have it unhedged, when the world becomes an uncertain place, like we're seeing now, the Aussie dollar tends to fall. When the Aussie dollar falls, the value of your overseas shares actually go up. And so it actually provides that and that's actually an important part of actually buffering some of that uncertainty which is out there. So we build a very diverse portfolio. We have a home bias because the liabilities you have in terms of what you've got to spend your money on is based generally in Australia. But we've got a diverse portfolio where we've got a bias at home, and but we have significant investments overseas, and we're just looking. We weigh every time we look overseas. We take into account where it's going, what country, if it's in a particular country. Our fund managers work with us on that. So it's there's a lot. When you break it down, there are a lot of individual investments, but we've got and we've got quite a lot overseas, but we've also got quite a lot at home.
Thanks, Mark. Now, we've probably got time for maybe 2, maybe 3 more questions. So if you have a question, no? I just saw a hand there. No? No more questions? Pretty good from the floor? Yeah. Oh, this gentleman you want to come back to? I'm sorry, I can't remember your name. One of our very first questions.
Hi, my name's Lance. And this is a separate question. I'd just like to know, just going on to investment options, projects, what restrictions is on Ryder Super investing in construction projects or other community projects or whatever else? Thank you.
Yeah, in terms of when we think about the restrictions we have, probably the first place we start really comes down to the return we're going to get on the investment. It does come down fundamentally that, as I mentioned earlier, about we have a responsible investment approach, but really what it's about, it's in your best financial interest. So the most important thing, whether we invest in a particular project anywhere or a particular investment, is the return and then the risk. And they're the critical things. We also, when we build portfolios, we actually set what we call a strategic asset allocation. How much do we put into shares? How much do we put in property? How much do we put in infrastructure? How much do we put in fixed income? So that provides another constraint that for the My Super Fund, it's very diversified. So other funds can be more growth orientated, some a bit less. So the funds, the funds, except that they're a single option, they're just property, they're going to be very diversified. So those type of constraints, the return, the risk, and then the asset allocations that we determine for our fund are really the key, and the key is really driving the decision about whether we do or not.
Thanks, Mark. Another question? Quickly squeeze one more in. Stacey will get the microphone too.
What is the difference between My Super and the super I was originally in with local government? Or is the one I was originally in?
It's all right, just hold it closer to your mouth. It'll pick it up.
Sorry. Oh, that better?
Yeah.
What is My Super, and what is that compared with? I'm actually on a pension account now, but originally I was with local government super, and I'm just wondering, I've got a small My Super account, but I don't know what to do with it.
Yeah,
might be.
Look up.
Might be one for a super health check afterwards.
So, yeah, that's the point. Look, My Super is our default option. So if members decide or members don't want to make a decision about the option that they sort of want to put their money into, then it will automatically go into My Super. And it's governed by a range of different rules. We have a special licence for it, actually. My Super is an accumulation option. And so it has the same asset allocation as our balanced fund.
Pretty much.
isn't it? It's basically the same.
Except for equities.
Except
for private equity.
Yeah, so it got basically the same type of structure as our balance fund, which is the one that you can invest in when you go into an income stream account. When you go into an income stream account, it is possible to keep open an accumulation account, and my guess is that that's what you've done. But I would absolutely encourage you to go and talk to Yusuf, one of the team members up there. He's the guy who's waving his hand with his microphone, and talk about, you know, what you might want to do next with those monies.
Thanks, Kate. And maybe time for one more question. So if you've got something, a burning question, a burning issue you want to ask about? One more? No? Okay. Well, we can wrap that up, ladies and gentlemen. So a reminder that our executive leadership team and the chair are available to answer any of your questions afterwards. And for those who pre-submitted a question or asked one online today, please rest assured that the team will be in contact with you to answer any questions you have. Just like to thank all of you, our members, for attending our 2022 annual members meeting. We will have today's video and minutes of the meeting available on the website in the coming weeks. Please don't forget to complete the feedback form. There's one on your chair, which you would have seen just before you sat down. They even provided a complimentary pen for you to fill that out, which would be fantastic. And you can also collect a copy of the 2021-2022 annual report before you leave. For those online, the annual reports are now available on the Brighter Super website, and a survey will also appear when you leave this meeting, and we would very much value your feedback. For those of you interested, don't forget we have our staff to offer our super health checks, as well as members of our advice team to help you with any questions about your interests that you may have. I invite you to join us for some light refreshments. Thank you, and please thank our panel and our speakers here today. Thank you very much.